Okay, in this video, we'll talk about how to account for available for sale debt securities. Those are those securities that you're not planning on holding to maturity necessarily, but you're also not planning on selling them right away. Those would be trading securities. They're the in-between. So we do report them at fair value. So when their value changes during the year, and you come to the end of the year, you're going to have an unrealized holding gain or loss. Meaning, the value was 100, and now it's 70. You have an unrealized loss of 30, say. That unrealized gain or loss will be reported in other comprehensive income. Okay, so it doesn't go in the income statement between revenue and net income. It's not in between there. It's after that on the statement of comprehensive income. And that loss then will be in your stockholders' equity. Accumulated other comprehensive income. Some of you guys may need to review this. If you do, let me just write it down here. Accumulated other comprehensive income. If you need to review that, do go review that. That is a component of stockholders' equity. What is in there? Well, things really like changes in fair value of things like this, or perhaps a foreign currency translation adjustment. Things like that don't hit net income. Why don't they hit net income? Well, the FASB's concluded that it wouldn't be fair to CEOs. It's not really their fault, for example, that the foreign currency, say Japanese yen, where they do business, the value of that has changed relative to the US dollar, or in this case, you've had an unrealized gain or loss or something. So it's still reported on the balance sheet. You still do, if you have an unrealized loss, you lower the value of your available for sale security there, but it won't lower your net income. Anyhow, let's look at it here. Example, Gruffalo Corporation buys some bonds here. They're $100,000 bonds. The bonds sell for $108,111, so they got a premium there. And there's some other details there we might need. When we buy it, let's record the purchase. Pretty simple, right? Debit the debt investment account and credit your cash. Okay, and we would make an amortization schedule the same as if it was held to maturity. You still amortize premiums and discounts, and the schedule would look like this. And again, that's because the effective rate, the yield, is 8%, so your interest revenue is based on that yield, 8% times the carrying value times half a year for each row, because this is every 6 months. They're semi-annual bonds. All right. So then, how do we record the interest on the first interest period, July 1st, 2013? Well, if we did the amortization table, you have the answer already. Here's what would happen. You get $5,000 cash because it's 10% times 100,000, and it's split up into 2 payments for the year, semi-annually. So $5,000 is your payment. You're going to credit the debt investment account. You're going to reduce that carrying value because you're knocking away at that premium, and you're going to have interest revenue there. And again, that interest revenue is just the take that carrying value times the effective rate times half a year. That's how we got that. All right, and then that 676 comes from here, which is just equal to the difference between those two items there. Then at the end of the year, to recognize accrue the interest revenue, we just look at the next line of our amortization table. So important to get good at doing those amortization tables, because once you do that table, you have your answers for any question. And so that is the total interest revenue for the year. You can just add those two together. Okay. Let's do something a little different than we did for held to maturity then. Let's assume that at the end of the year, it's the end of their fiscal year too, let's say, December 31st, 2013, the fair value of the bonds is $105,000. Okay, but at the end of the year, the carrying value is actually 106,732. So the carrying value is 106,732, but now the fair value is 105. What are you going to do? Well, here's what you're going to do. You're going to debit this account, unrealized holding gain or loss, hyphen equity. It's very important. Hyphen equity. Don't forget that. All right. That's a loss account. It's going to hit other comprehensive income. And you're going to credit this fair value adjustment, parentheses, available for sale, or the difference. You see that difference, right? 106,732 minus the 105,000. That is how we got that number there. All right. What is this account, this fair value adjustment? Well, it's on the asset side. It's a kind of an adjunct account. It always goes with debt investments or equity investments. Always goes along with it. It's kind of like accumulated depreciation in many senses. But it's a little bit different than accumulated depreciation because it can be a debit or a credit balance, right? If the fair value had gone up, we would reverse the debit and the credit here, and this account would actually have a debit balance. All right, so let's keep going with that concept. Try to cement that in your mind. Riley Corporation, they got 2 debt securities. They're both available for sale. And here is a chart about them at the end of their year. They got some Watson bonds. They got some Anacomp Corporation bonds. And here's what we paid for each bond. And here's its current fair value. And so the difference between the two of them is going to be our unrealized holding gain or loss. Oops, I'm using an eraser here. Okay, so we have, looks like we have okay, the fair value is greater than the cost. We have an unrealized gain. And then the second one, the fair value is less than the cost. We have an unrealized loss. So in total, we have an unrealized loss of $9,537. Very important information here. The previous fair value adjustment balance. Remember that fair value adjustment account, FVA? The previous balance is 0. All right? Because the previous balance is 0, and my goal is apparently to have an unrealized loss. Yeah. So, okay, my goal will be to credit it, to have a credit balance of 9,537. That means I have to credit it for 9,537. This is a lot like doing the bad debt expense. You need to understand where you're starting out, because this information here, the fair value adjustment credit of 9,537, that's where you want to end up. But if you already have a balance in there, then you're not going to have to credit it for as much. But as it is, it's pretty simple in this case. You credit it for the full amount to record the loss. Okay. Okay, and then if you sell an available for sale security before the maturity date, you just make the entries to remove the debt investment account. And if you have at that point, when you'll have a realized gain or loss, it won't be unrealized, and that will go in your income statement under the other category. So as an illustration, Riley sells some bonds, some Watson bonds, for $90,000 at a time when the amortized cost was $94,214. They have a loss on sale at that point of $42.14. So here's the cash, loss on sale, and credit the debt investment account. All right, so there's really no, when you sell the bond, there is no journal entry at that point to adjust your FVA account, your fair value adjustment account. There's no journal entry for that at that point. When will that account be adjusted? Well, you'll just wait until the end of the next reporting period. And you look at not just that bond, you look at all your bonds, and you'll see what the total fair value adjustment necessary is, and you'll make an adjustment at that point. There's no adjustment right now. Okay. So let's keep going with it a little bit. So then Riley reports this realized loss as an other expense or loss in their income statement. And they don't buy any more or sell any more bonds for the rest of the year. So we come to the end of the year, and they give you this information on their other bond, the Anacomp Corporation bond. Amortized cost is still $200K, of course. The fair value is now $195. So we have an unrealized loss of $5,000. So here's what I'm talking about with the FVA account. FVA. Remember, it previously had this credit balance of $95.37. And now it needs to have a credit balance of $5,000. So you actually need to debit it for $45.37 in order to end up where you want to end up, which is you want it to have a balance of $5,000 on the credit side. Okay? So that's actually the answer. And I think that's enough for this video.